you think about that logo, those two interlocking circles, you see it everywhere.
Uh-huh.
And most people probably just associate Mastercard with, well, swiping a card or tapping their phone, paying for stuff.
Right. The transaction itself.
But if you actually peel back the layers, especially when you look at how they talk about themselves, like
Yeah.
in their latest annual report, you find they're really positioning themselves as something much bigger.
Yeah, much more than just the plastic. They frame themselves as a global technology company.
A technology company operating in this payments world that's just changing incredibly fast.
Absolutely. And that annual report, specifically their 10K filing with the SEC, that's our source material for this deep dive.
Okay, great. So let's unpack this. This document, it's not just some glossy marketing thing.
No, not at all. It's the required detailed filing.
It's their formal account covering everything from, the real nuts and bolts of how they make money or their strategy, but also down to the specific concrete risks they see on the horizon.
Exactly. And our mission here is really to cut through some of that dense corporate language.
Yeah, get to the core of it.
We want to pull out the key insights for you. What's really driving Mastercard, where they're putting their energy, and maybe most importantly, what challenges are they actually telling regulators they're worried about? It's their own perspective.
And you mentioned the filing has some visuals too, diagrams and things.
It does, yeah. Diagrams of their network, which can actually be pretty helpful to clarify how all the pieces fit together.
Perfect. Okay, so let's jump right in. The core identity. How does Mastercard actually define itself in this document?
Right at the start, the filing calls Mastercard a technology company in the global payments industry. That's the phrase they use.
Technology company first.
Yeah.
Interesting.
And their main role, connecting everyone in that whole payments chain. Consumers, banks, financial institutions, merchants, governments, digital partners, businesses, all over the world.
And it's about making electronic payments happen, sure, but they seem to put a lot of emphasis on how they do it. They use phrases like making transactions secure, simple, smart, and accessible.
That's right. They stress that their network provides choice and flexibility for everyone involved.
Okay.
And the core function they really highlight, visually shown with those interlocking circles and arrows, is what they call switching.
Switching. Okay, what does that mean in practice?
It's the process where they authorize, clear, and settle the payment transactions. It all happens through their specific, unique global network.
So when you tap your card or click pay online, their network is doing that crucial job of getting the okay and moving the information along.
Exactly. And the document makes a point that it's not just about traditional card transactions anymore.
Ah, right. What else are they handling?
That's a key point. They also handle ACH transactions, that's automated clearinghouse. So batch payments, real-time account-to-account payments. They're expanding beyond just the card rails.
Okay, so broadening the types of payments they process. And the scale sounds just massive.
Oh, it is. The filing mentions operating in over 150 currencies
Wow.
across more than 220 countries and territories, connecting something like 150 million physical acceptance locations and over 250 million digital access points.
That global reach is just hard to wrap your head around sometimes.
It really is. And there's an ecosystem diagram in the filing that's super helpful for understanding how they see their place in all this.
Okay, what does that show?
It shows the main players. You've got the account holder, that's you or me, the merchant selling the goods, the issuer bank that gave you the card, and the acquirer bank that the merchant uses.
Right, the key parties in any transaction.
And Mastercard's payment network sits right there in the middle. It's the hub.
The hub, okay.
Exactly. It shows how their network does the switching, that authorization, clearing, settlement. And then layered on top, you see their services and other solutions.
Ah, the extra stuff.
Right. And it's all built on a foundation labeled Payments Ecosystem Security. But they also emphasize their franchise model here.
Franchise model. What's the significance of using that term?
Well, it's important because it signals they don't just provide the pipes, the network itself. They also set the rules, the standards, the operating guidelines for everyone using that network.
So they control how it works.
Pretty much. This model ensures interoperability, making sure a Mastercard from Japan works in Brazil, and it helps them balance the value they provide with managing the risks across the whole system. It gives them significant influence.
Okay, that makes sense. So that's the structure, the role they play. How does that all translate into actually making money? What's the revenue picture look like?
The filing breaks down their net revenue into two main categories, two big engines. There's payment network revenue, And then there's value-added services and solutions revenue.
Okay, let's tackle the payment network side first. What are the key things driving that revenue?
That part is primarily driven by a few key metrics. First is gross dollar volume, or GDV.
GDV, what's that exactly?
That's the total dollar value of all the purchases and cash advances made on cards carrying their brands. Basically, how much money is flowing through.
Got it. More spending, more volume.
Yep. Then there's cross-border volume growth, how much spending is happening across country borders. They specifically highlight this one. And finally, switch transactions, just the sheer number of individual transactions they process.
So the more people spend using Mastercard, especially when they travel or buy internationally, and just the more taps and swipes overall, that drives this side of the business. You said cross-border is particularly important.
It is. The filing points out that those cross-border transactions generally have a higher growth rate for them, which means they're often more lucrative per transaction.
Ah, okay.
And the revenue itself comes from different assessments based on these metrics. Things like domestic assessments, cross-border assessments, transaction processing fees, and then some other network fees like licensing, implementation costs, franchise fees.
Got it. Fees based on volume and activity. Now, what about that other big piece? Value-added services and solutions. What's the story there?
Right, so this is where they go beyond just processing the payment. These are services built on top of the network or leveraging the network's capabilities, but they can often be sold separately too. It's definitely a strategic focus area.
Seems like a way to get more value out of the infrastructure they already have. What kind of services are we talking about here based on the filing?
It's a pretty broad list. Security solutions are a big one. Not just fraud prevention at the checkout, but things like helping organizations monitor their overall cybersecurity posture, the EMV chip technology, contactless payments.
Okay, security makes sense. What else?
Then there's consumer acquisition and engagement. Think marketing support for banks to issue cards, loyalty programs, personalized offers, even access to things like airport lounges or concierge services that sometimes come with premium cards.
Ah, so when you get those perks with your card, Mastercard might actually be the one providing or enabling them behind the scenes.
Exactly, that's often the case. They also offer business and market insights. This is where they leverage all that transaction data anonymously, of course, to provide economic trends, location insights for businesses, or even consulting services.
Using their data advantage.
Right. Plus, more technical services like payment gateways, processing services, open banking initiatives, and those ACH solutions for account-to-account payments we mentioned earlier.
Okay.
The document says these services drive value for our customers and the broader payments ecosystem. But importantly, they're also explicitly mentioned as a way to generate more revenue and accelerate the company's overall financial performance.
Yeah, it really sounds like they're deliberately building out revenue streams that aren't just tied to that single transaction swipe fee. Diversifying.
That's precisely the picture they paint. They're using the network's data, reach, and infrastructure to build this whole suite of other offerings.
So with that network and that revenue engine humming, where is Mastercard focusing its energy for future growth? What's the strategy according to the 10K?
Their strategy, as they lay it out, has three main pillars. First, growing our core. Second, diversifying our customers and geographies. And third, building new areas for the future.
Okay, grow, diversify, build. How do they actually execute on that? What specific actions are they highlighting?
Well, a big one is what they call the significant secular opportunity of cash displacement.
Displacing cash, so getting rid of physical money.
Essentially, yeah. Actively working to increase acceptance of electronic payments everywhere. Using technology, forming strategic partnerships, trying to open up payment networks in some countries that have been traditionally closed or domestic only.
And targeting specific areas.
Yes, targeting areas where cash or checks are still heavily used, like bill payments. They see that as a big untapped market.
So basically, find where cash is still king and try to replace it with Mastercard.
That's the goal. Another key action is driving brand preference, making people want to use Mastercard.
How do they plan to do that?
Through better consumer experiences, compelling value propositions. Think about those loyalty benefits. Again, strong digital features. They mention digital-first initiatives and enhanced security like tokenization, which makes online checkout smoother and safer.
Right. Make it the easiest, safest, maybe most rewarding way to pay.
Exactly. They also talk explicitly about investing in the future and driving market transformation. This gets interesting. It involves extending their network's capabilities beyond just payment card numbers.
Beyond card numbers, like what?
They mention enabling the tokenization of other things like digital identities, digital assets, even data itself,
Yeah.
and constantly modernizing their core switching infrastructure to handle this.
Wow, okay. That's a pretty big vision. Moving their network towards handling secure exchanges of all sorts of digital things, not just money tied to a card number.
It really broadens their potential role in the whole digital economy.
Mm.
Then on the commercial side, they're targeting commercial invoice payments, especially B2B.
Business to business payments. That's notoriously complex, right?
It is. Lots of paper, manual processes still. So they're focused on simplifying those complex workflows, improving the data that travels with the payment, and embedding their payment solutions directly into the platforms businesses already use.
Oh, like accounting software or industry-specific platforms.
Exactly. They mentioned focusing on verticals like healthcare, trade logistics, consumer packaged goods, pharma.
That seems like a huge opportunity if they can crack it.
It definitely is. They're also focused on modernizing disbursements and remittances, sending money out.
Okay, what does that involve?
They have a capability called Mastercard Move. It's about enabling different groups, consumers sending money, businesses paying workers, governments distributing benefits to send money more easily and efficiently, both within a country and across borders, all leveraging their existing network of banks.
So faster, simpler ways to get paid, send money home, or receive government aid, maybe.
Precisely. And then the final piece is expanding services distribution.
Selling those value-added services we talked about.
Right. Packaging them better, enhancing the suite for current and new customers, and scaling up how they actually sell and deliver these services using tech platforms, their dedicated sales teams, and embedding their services with partners like other tech firms or payment processors.
So in short, sell more services, sell them more effectively, and use more channels to do it.
That really sums up the multi-pronged approach they outline in the filing.
Okay, so that's the plan. Let's look at the numbers. How did this strategy actually play out in 2024? How did the performance look compared to 2023 according to their own filing?
Well, the key financial highlights they provide show pretty strong growth, actually. Net revenue was up 12%,
12% increase in revenue.
or 13% if you adjust for currency fluctuations. And the filing specifically attributes this growth to both sides of the business, the payment network, and those value-added services and solutions. Both contributed.
Okay, so that strategy of growing the core and expanding the services seems to be showing up in the top-line results.
It appears so. Now, operating expenses also went up. They were up 13% as reported, or 11% on an adjusted currency-neutral basis.
And what drove that increase in costs?
The document mainly points to higher general and administrative expenses and litigation provisions.
Ah, litigation costs again. Seems like a recurring theme.
It's definitely a significant factor they call out. On the profit side, they reported adjusted net income grew 17% year over year, and adjusted diluted earnings per share, or EPS, grew 19%.
Solid bottom line growth too then.
Yeah. And one other note, depreciation and amortization increased by 12%. They link this primarily to increased software capitalization, basically, reflecting ongoing investments in their technology and business infrastructure.
Okay, so financially, 2024 looks pretty robust for Mastercard on the surface. Good growth. But as you said, the 10K is where companies have to lay out what could go wrong, the risks. What are the big ones Mastercard identifies for itself?
Yeah, this section is always the reality check, right? It shows the headwinds they're navigating. And one of the most prominent areas they highlight is the regulatory and political environment.
Regulation. Why is that such a major concern for a global payments network like them?
Well, it explained that just the increase in regulation and oversight leads to significant burdens, more compliance work, higher governance costs, bigger operating expenses. That's kind of the baseline impact.
Just the cost of doing business in a regulated world?
Right. But the deeper risk they identify is that these regulations might make their customers, the banks, the merchants, less willing to participate, reduce benefits, lower volumes, or even disintermediate Mastercard altogether.
Disintermediate. You mean cut them out of the loop entirely?
Exactly. Build their own systems, use alternatives. The concern is that regulation could push participants away from using Mastercard's network. They even explicitly mention potential regulation, specifically targeting their network fees.
Oof, hitting them right in the revenue model.
Potentially. And they point to a really significant trend here: the rise of digital public infrastructure and other government-backed solutions.
Like central banks or governments creating their own payment systems?
Precisely. They actually name examples like Brazil's PIX system, the U.S. FedNow service, India's UPI. They state these are increasingly seen as alternatives to traditional domestic payment solutions, such as ours.
So direct competition from government initiatives.
Yes. And they also note governments exploring central bank digital currencies, CBDCs, which could potentially operate on their own separate government-run networks, completely bypassing private networks like Mastercard's.
Wow, that feels like a fundamental challenge to their whole model, coming directly from governments. They must be pretty worried about that.
They're definitely flagging it as a material risk. They also mention the risk of regional groups, like economic blocs, potentially restricting transactions within their borders from being processed by global networks like Mastercard.
Keeping payments local.
Right. Furthermore, they note increased regulatory focus on data use and artificial intelligence, AI, which could impact their ability to innovate, especially in areas like fraud monitoring or developing new data-driven services.
And they mention specific rules too, like something from the CFPB in the US.
Yes, they call out the Consumer Financial Protection Bureau's rule on data access. It requires data providers, like Mastercard, to make consumer financial data available to consumers themselves and authorized third parties. Compliance starts phasing in from April 2026.
More compliance hurdles.
Exactly. And they also state that as they expand into new areas, like money transfers with Mastercard Move, they need different types of licenses, money transmitter licenses, for instance. These come with their own set of supervisory requirements, capital rules, risk management burdens, separate from their core card network activities.
So the regulatory pressure isn't just on their existing business, it's also making their growth and diversification strategy more complicated.
That's exactly right. And they also highlight the challenges of complying with global economic sanctions and related laws.
Sanctions compliance, that must be incredibly complex for a global company.
Hugely complex. They mentioned the risk of losing business due to sanctions, but also, critically, that their own compliance could be compromised if their partner banks or merchants fail to comply properly. They're dependent on the whole chain following the rules.
And the filing even includes a specific disclosure about some transactions related to sanctioned entities, doesn't it?
It does, yes. It's quite specific. The document states that as part of their compliance program, they found that a European acquirer processed some transactions over their network for an Iranian airline.
Okay.
And they also mentioned that in the last quarter of 2024, an acquirer based in the Eastern Europe, Middle East, and Africa region processed transactions related to consular services provided by an Iranian embassy.
And they have to report this under a specific rule, Section 219, even if it wasn't technically an OFAC violation.
That's correct. The filing explicitly states that disclosure is required by Section 219 and is made irrespective of whether the described dealings violated regulations administered by OFAC. It just shows the incredibly tight spot they're in. With global compliance, they can be exposed indirectly through their partners' actions.
Wow. Okay, shifting gears from regulation, what about legal risks? Lawsuits and things like that?
That's another major risk area they detail. Mastercard is involved in numerous civil lawsuits and regulatory proceedings. They specifically call out competition law, or antitrust, and intellectual property claims as key risk areas.
And antitrust cases, especially big class actions, those can carry massive potential damages, right?
They absolutely can. They state that significant damages are possible and specifically note the potential for treble damages in antitrust cases, meaning damages could be tripled.
Triple damages, ouch.
And the concrete impact of this risk is really clear. When you look at the litigation provisions they've recorded, the money they've set aside, it was $680 million in 2024.
$680 million set aside in 1 year.
And it was $539 million in 2023. So yeah, over $500 million each year earmarked for potential legal losses or settlements.
That's a huge number. What's driving those big provisions? Is it one specific case?
The filing explains it's mainly driven by a few key areas. The 2024 provision was largely due to a settlement related to a UK consumer class action lawsuit, plus settlements with several UK merchants, and also a change in their estimate for liabilities related to U.S. merchants who had opted out of previous big settlements.
Okay, so ongoing battles, especially with merchants over fees and rules, seem to be a major source of these costs.
That's definitely what the filing suggests. The 2023 provision was similarly driven by those U.S. merchant opt-out claims and settlements with European merchants. It's a recurring issue.
And what's the company's overall stance? Do they think any one case could sink them?
They state they don't believe the outcome of any single existing case is likely to be material on its own. However, and this is the important part, they caution that adverse outcomes in these matters could result in substantial fines or payments, and significantly could require them to change their business practices.
Forcing them to change how they operate.
Right. And they conclude that such outcomes could have a material adverse effect on their overall business, financial condition, and results. So while no single case is seen as fatal, the cumulative risk is significant.
Okay. Let's switch to information security, cybersecurity. For a company whose entire business is a network, this has got to be top of mind, but also a massive risk.
Oh, absolutely paramount. And they're very open about it in the filing. They acknowledge the risk of material breaches and resulting losses, not just hitting them directly, but also affecting third parties they work with.
And they mention insurance.
They do. They state that their insurance coverage may not be adequate to cover all potential losses from a major breach.
That's sobering. Is this risk getting worse or staying the same?
They explicitly say the risks are heightened. Why? Because the threats themselves are constantly evolving, because Mastercard has such a prominent role in the global system, because they rely heavily on third-party vendors, and also because vulnerabilities can be introduced through acquisitions.
Right. Buying other companies brings in their systems too.
Exactly. They note it requires significant additional resources just to try and keep up modifying and enhancing their protective measures constantly.
And can they even be sure they haven't already been breached without knowing it?
That's one of the most striking lines in this section of the filing. They state, "We cannot eliminate all risks from cybersecurity threats or provide assurances that we have not experienced an undetected cybersecurity incident."
Wow. So they acknowledge it's possible they've been hit and don't even know it yet.
It really underscores just how constant and pervasive this threat is for them.
You mentioned acquisitions introducing cyber risks. Are there other risks associated with their strategy of buying other companies to grow?
Yes, they dedicate a section to acquisition and integration risks. They identify that they may not be able to successfully partner with or integrate the companies they acquire.
Integration is always tricky.
Always. And they point out it can divert management's time and resources and disrupt our operations. There's also the risk that they spend a lot of time and money on acquisitions or strategic projects that just don't pan out, don't meet expectations, and they might end up having to sell them off later, maybe at a loss.
So the risk of failed M&A.
Right. And they also note that acquisitions can increase their exposure to litigation and just increase their ongoing operating costs after the deal is done.
The filing mentioned that a big chunk of the increase in goodwill on their balance sheet in 2024 was from buying a company called Recorded Future. That sounds like a prime example of executing that strategy of acquiring services businesses.
It absolutely fits their strategy of expanding services, particularly in security and intelligence, given what Recorded Future does.
But it comes with all those integration challenges and risks they just laid out.
Exactly. They're executing the strategy, but they're also upfront with investors about the potential bumps in the road that come with integrating these new pieces.
Okay, finally, there was an interesting, almost unique-sounding risk factor related to the Mastercard Foundation's shareholding. Can you explain that? What's that all about?
Yeah, that is pretty unique to Mastercard. The Mastercard Foundation is a large, independent Canadian charitable foundation. It received a huge chunk of Mastercard stock way back when the company first went public in 2006.
Okay, a big long-term shareholder.
Historically, there were significant restrictions on the foundation selling those shares, but those restrictions were lifted in early 2024.
So now the foundation can sell its shares.
It can, and it has a plan to do so, but gradually. Starting in March 2024, they began selling shares as part of a prearranged plan that will unfold over 7 years. They do say they still intend to remain a significant long-term holder, though.
Okay, so they're selling, but slowly. How does that translate into a risk for Mastercard, the company?
This is the interesting part. The filing points out that because the foundation's directors are totally independent from Mastercard's management, and because their plan is very long-term, selling over 7 years, the foundation may not have the same interest in short or medium-term movements in Mastercard's stock price compared to other typical shareholders.
Right, they're not focused on next quarter's earnings announcement driving the stock up.
Exactly. And Mastercard notes that this large, long-term holding, combined with the foundation's independent perspective and gradual selling plan, could potentially discourage or make more difficult acquisition proposals for Mastercard itself.
That's fascinating. They're basically saying that one of their biggest shareholders, because of its structure and long-term view, might inadvertently make Mastercard a less attractive takeover target or harder to acquire, and they list that as a risk factor to the company.
It's certainly a unique aspect stemming from their IPO structure and something they felt was important to disclose as potentially impacting shareholders or M&A activity down the line.
Were there any other, maybe smaller, but still interesting little details that popped out from the filing? Things that add a bit more color?
Yeah, just a couple of quick things that help paint a broader picture. They briefly mentioned their corporate culture is guided by something called the Mastercard way.
Okay, what's the MasterCard way?
It has three core principles they list: create value, grow together, move fast.
Simple, action-oriented. Sounds about right for a tech payments company.
Pretty standard corporate values, yeah. They also highlight their focus on talent and culture, mentioning things like employee development programs, flexible work policies. They specifically name their work from elsewhere option, and also community giving initiatives as being important parts of how they operate.
Okay. And there was a note about a tax break somewhere. Singapore.
Yes, quite a significant one. They mentioned an incentive grant they have from the Singapore Ministry of Finance tied to their regional operations headquartered there. This resulted in a reduction of their income tax liability by $644 million in 2024 alone.
Wow, $644 million. That's a substantial benefit linked to their global structure.
It definitely highlights the financial importance of their global footprint and where they choose to operate certain functions.
And just confirmation they own their main buildings, like the HQ in New York and the big tech center in Missouri?
Right, just sort of the basic structural details that fill out the picture of their physical presence and operations.
Okay, great. Let's try and bring this all together then. After digging through this 10K, what are the really big takeaways? How does MasterCard see itself and its future based on their own formal reporting?
Well, I think it strongly reinforces that view of MasterCard as fundamentally a technology and network company, moving well beyond just being a card company.
Right, the tech focus is clear.
And they are very actively, strategically expanding their capabilities, going beyond traditional consumer card payments into commercial B2B, into disbursements, remittances, and really leveraging their data and tech infrastructure for that whole suite of value-added services.
And that services side seems crucial.
It's clearly a major growth engine they are pouring investment into. It's not just an add-on anymore, it's central to the strategy.
And while the 2024 numbers looked pretty strong, double-digit growth in revenue and earnings, the document really forces them to lay bare the significant external pressures they're facing.
Absolutely. That's the other side of the coin. The major risks they identify themselves are serious. That potential existential challenge from evolving global regulations, especially the rise of government-backed payment systems and CBDCs.
Yeah, that seemed huge.
The very real, concrete financial impact and potential business practice changes coming from ongoing litigation, particularly antitrust.
Millions of dollars set aside every year.
And that ever-present, constantly evolving threat of major cybersecurity breaches. It all demonstrates they are operating in an incredibly complex, challenging environment that they are, frankly, acutely aware of.
It really drives home the value of looking at these required filings. You get a very different perspective, their own internal risk assessment and strategic roadmap laid out, warts and all, not just the polished public story.
Exactly. It's the unvarnished view, the one required by regulators, and it offers crucial context for understanding where a company like this truly stands and where it's headed.
So here's maybe a final thought for you, our listeners, to chew on as you think about MasterCard and the future of payments. Given that significant risk MasterCard itself identifies from government-backed digital payment systems, things like FedNow or PIX, and potential central bank digital currencies creating entirely new payment rails, how might the fundamental role, the very business model of these global, privately operated networks like MasterCard's need to adapt or change or figure out how to coexist in the years ahead? What does that growing tension between public and private payment infrastructure really mean for how money is going to move around the world in the future?